Hello, welcome to Capital Sensei. Today we're going to dive deep into one of the most essential books ever written on investing, The Most Important Thing by the legendary investor Howard Marks. We won't just summarize it, we'll dissect its core philosophies, exploring profound concepts like second-level thinking, the true nature of risk, the crucial role of market cycles, and how to cultivate the mindset that separates the great investors from the rest of the crowd. We try to answer as many questions as we can in the comments section. So, if you have any doubts while we go through this, or if you have your own stories and insights about investing, please share them below. Your experiences help everyone learn and build a smarter community of investors together. So, let's start with what Howard Marks himself says is, well, the most important thing. It's the concept of second-level thinking. Now, what on earth is that? To understand it, we first have to understand its opposite, first-level thinking. First-level thinking is simplistic and superficial. It's the knee-jerk reaction. For example, a first-level thinker says, "This company just reported great earnings. The outlook is fantastic, so I'm going to buy the stock." It sounds logical, right? The problem is, it's the same thought everyone else is having. Second-level thinking is much deeper. It's complex and requires real work. The second-level thinker also sees the great earnings report, but then asks a series of more difficult questions. Questions like, "Okay, the company is doing well, but how good is it compared to what everyone was already expecting? Is this good news already reflected in the stock's price? If everyone is buying based on this news, who's left to buy tomorrow? What could go wrong? What's the full range of possible future outcomes, and not just the rosiest one?" Think of it like a poker game. A first-level player looks at their hand and thinks, "Wow, I have a pair of aces. That's a great hand." They bet aggressively based only on their own cards. But a second-level player sees their pair of aces and immediately thinks about the table. What could the other players have? Based on how they've been betting, what kind of hand are they representing? What do they think I have? It's a game of psychology and probability, not just a game of holding good cards. Investing is the same. You're not playing against a spreadsheet. You're playing against other people. To win, you can't just do what everyone else is doing. You have to have a different and better thought process. The consensus view is already baked into the market price. So if your analysis is the same as everyone else's, you can't expect to get above average results. Superior returns don't come from buying good companies. They come from buying good companies at a great price, and that only happens when your view is different from the crowd's, and you turn out to be correct. This leads us directly to the next most important thing, which is understanding market efficiency. There's a famous theory in finance called the efficient market hypothesis. In simple terms, it says that all available information is already reflected in asset prices. If this were perfectly true, then nobody could consistently beat the market, because there would be no undervalued or overvalued stocks to find. The price would always be right. Now, Howard Marks has a more nuanced view. He agrees that markets are pretty efficient. You're not likely to beat Wall Street just because you have a faster computer or can read a financial statement more quickly. Thousands of very smart, highly motivated people are doing that every single day. The idea that you can consistently gain an edge through pure analytical skill, what Marx calls the no more school of investing, is a tough game to win. So where does the edge come from? It comes from the fact that markets are not perfectly efficient, and the source of that inefficiency isn't a lack of information, it's human psychology. Markets are made of people, and people are driven by powerful emotions like greed and fear. These emotions cause them to make systematic errors, pushing prices far above or far below their true value. This is where the second-level thinker finds their opportunities. They are trying to out-analyze everyone. They are trying to out-psychologize them. Imagine a giant farmer's market. Most of the time, the price of apples is fair. The vendors all know what apples are worth. But what if a rumor spreads that a new study found apples cause a terrible disease? People panic. They stop buying apples. The vendors, desperate to sell their inventory before it rots, start slashing prices. Suddenly, apples are incredibly cheap. A first-level thinker joins the panic. A second-level thinker asks, is this rumor credible, or is this a temporary fear-driven overreaction? If they conclude it's an overreaction, they can buy high-quality apples for pennies on the dollar. They exploit the inefficiency created by fear. This brings us to another most important thing: understanding value. This is the bedrock of intelligent investing. At its core, value investing is simple. It's the discipline of trying to buy something for less than its inherent worth. It's not about buying stocks that are statistically cheap based on some simple metric like a low price-to-earnings ratio. It's about figuring out what an asset is truly worth, its intrinsic value, and then trying to buy it for a lot less than that. The key distinction here is between price and value. They are not the same thing. Price is what you pay. Value is what you get. An investor's job is to always get more in value than they are giving up in price. A cheap stock isn't necessarily a good value, and an expensive-looking stock isn't necessarily a bad one. It all depends on the relationship between the price you pay today and the value you receive over the long term. Think about buying a car. You see two used sedans. One is priced at $5,000 and the other is priced at $15,000. The first-level thinker says, the $5,000 car is the better deal because it's cheaper. The second-level thinker digs deeper. They discover the cheap car has a bad transmission and a rusty frame, and will cost thousands in repairs. The more expensive car, however, is in pristine condition, has low mileage, and comes from a reliable brand. In this case, the $15,000 car offers far more value for its price. The cheap car was just cheap. This leads perfectly into what Marx calls another most important thing: the relationship between price and value. This might sound like the same point, but it's a critical distinction. It's one thing to be able to identify a high-quality asset. It's another thing entirely to know when the price is right. A wonderful company can be a terrible investment if you pay too much for it. In fact, overpaying for a good asset is one of the easiest ways for investors to lose money. Let's take a historical example. In the year 2000, at the peak of the dot-com bubble, Cisco Systems was an incredible company. It was building the backbone of the internet. It was dominant, innovative, and growing like a weed. No one disputed that it was a great business, but its stock price was bid up to astronomical levels based on pure euphoria. If you bought Cisco stock at its peak in March of 2000, you would have had to wait more than 15 years just to get your money back, even though the company itself continued to be successful. The quality of the business was high, but the price was disastrous. This is where the concept of a margin of safety becomes absolutely essential. It's a term coined by the father of value investing, Benjamin Graham. The margin of safety is the gap between the intrinsic value of an asset and the price you pay for it. It's your buffer against bad luck, errors in judgment, and the unpredictable nature of the future. If you estimate a company is worth $10 per share, you don't buy it at $9.50. You wait until you can buy it at $6 or $7. That big discount is your margin of safety. It's the shock absorber that protects you from a permanent loss of capital. And that brings us to the next and perhaps most misunderstood, most important thing: understanding risk. Ask a finance professor what risk is, And they'll probably tell you it's volatility, measured by a statistic called beta. They'll say a stock that bounces around a lot is risky, and a stock that is stable is safe. Howard Marks says this is nonsense. Volatility is just the price movement of an asset. It's not risk itself. Who cares if a stock price goes down temporarily if you have high conviction in its long-term value and it eventually goes up substantially? Marx defines risk with beautiful simplicity. Risk is primarily the probability of a permanent loss of capital. That's it. When you make an investment, the ultimate risk is that you won't get your money back, let alone make a return on it. Everything else is just noise. The real danger isn't that a stock you own will go down 20% in a bad month. The real danger is that it goes down 20% and never comes back because you were fundamentally wrong about the business. He also points out that there are two main risks in investing: the risk of losing money and the risk of missing opportunities. Most people focus entirely on the first one. They are so afraid of losing money that they become paralyzed, especially during market downturns. But missing out on the incredible returns that are available when assets are cheap is also a huge risk to your long-term wealth. The challenge is to find a balance between being aggressive enough to capture opportunities and defensive enough to avoid permanent losses. One of the most profound insights Marx offers about risk is that it's often lowest when people perceive it to be highest, and highest when people perceive it to be lowest. Think about that for a moment. In 2008, during the depths of the financial crisis, the perceived risk of owning stocks or corporate bonds was off the charts. Everyone was terrified. But because of that fear, prices were incredibly low. For those who had the courage to buy, the actual risk of permanent loss was low, and the potential for future returns was enormous. Conversely, in late 1999 or 2021, the perceived risk was incredibly low. People thought tech stocks can't lose, or crypto is a sure thing. The lack of fear and caution pushed prices to bubble levels. This is when the actual risk, the risk of buying at a price from which you'll never recover, was at its absolute peak. The greatest danger in investing is not being in a scary market. It's being in a market where nobody is scared. So, if that's what risk is, the next most important thing is controlling it. You cannot eliminate risk. Investing is, by its very nature, the act of positioning capital to deal with an uncertain future. But you absolutely can and must manage it. The best investors don't get great returns by taking on more and more risk. In fact, it's the opposite. The best investors achieve superior returns with less risk than others. How do they do this? By insisting on that margin of safety we talked about. By buying assets for significantly less than their estimated value. This is the ultimate form of risk control. If your analysis is a little off, or if the economy takes an unexpected turn for the worse, your margin of safety gives you a cushion. It's the difference between a fender bender and a total wreck. Superior investors focus on not losing money first, and the gains take care of themselves. Imagine a structural engineer building a bridge. The city tells her the bridge needs to support 10 tons of weight. Does she design it to hold exactly 10 tons? Of course not. That would be incredibly reckless. She designs it to hold 30 or 40 tons. That massive extra capacity is her margin of safety. It protects against unforeseen stresses, material fatigue, or calculation errors. Investors must build their portfolios with the same disciplined, conservative approach. This is all tied into the next most important thing: being attentive to cycles. Marx is famous for his memos, and a constant theme is his mantra. We may not know where we're going, but we ought to know where we are. What he means is that while you can't predict the future, you can get a sense of the current market environment. Economies, companies, and especially investor psychology move in cycles. Nothing goes in one direction forever. These cycles swing back and forth like a pendulum. They move between periods of prosperity and recession, between easy credit and tight credit, and most importantly for us, between euphoria and depression in the market. The cycle of investor sentiment is the most powerful force of all. It swings from greed to fear, from optimism to pessimism, from credulousness to skepticism. The key is not to try and predict the exact top or bottom of these swings. That's a fool's errand. The goal is simply to understand where we are in the cycle. Are we in the early innings, when optimism is just starting to build? Or are we in the ninth inning, when euphoria is rampant and caution has been thrown to the wind? Knowing the answer to that question tells you whether you should be playing offense or defense with your portfolio. Think of a farmer. The farmer can't predict the exact day it will rain or the precise temperature next July. But the farmer understands the seasons. They know that spring is for planting, summer is for growing, and fall is for harvesting. They don't try to plant seeds in the dead of winter. An investor must have the same awareness of the market seasons. When fear is pervasive and prices are low, that's the planting season. When greed is dominant and prices are high, it's time to think about harvesting some gains and becoming more cautious. To visualize this, Marx uses one of his most powerful metaphors, the pendulum. Investor psychology is like a pendulum swinging back and forth. At one extreme is euphoria, where people believe everything is wonderful and risk has vanished. At the other extreme is depression, where people are convinced everything is hopeless and ruin is inevitable. The pendulum rarely, if ever, stops in the middle, rests at the happy medium in the middle. The bulk of its journey is spent moving toward one of these two emotional extremes. First-level thinkers get swept up in the pendulum swing. When it's swinging toward greed, they become greedy. When it's swinging toward fear, they become fearful. They buy high and sell low. The second-level thinker does the opposite. They understand that the pendulum's momentum creates opportunity. They recognize that the moments of maximum optimism are also the moments of maximum risk, and the moments of maximum pessimism are the moments of maximum opportunity. They lean against the swing of the pendulum. This requires fighting against the most powerful forces in investing, which leads to another most important thing: combating negative influences. And the most dangerous negative influences are not external, they are internal. They are your own emotions. Greed is a destructive force. It causes you to abandon your discipline and chase hot trends, often buying at the very peak. It's driven by the fear of missing out, or FOMO. Fear is equally destructive. It causes you to panic and sell during downturns, crystallizing temporary paper losses into permanent real ones. It's the feeling of sheer terror when you see your portfolio value dropping and you just want the pain to stop. Other negative influences include our own cognitive biases, the tendency to seek out information that confirms our existing beliefs, or to be overconfident in our own predictions. The only way to combat these powerful internal forces is to have a well-reasoned, robust investment philosophy that you trust, and the discipline to stick with it. Your philosophy is your anchor. It's what keeps you grounded when the emotional storms of the market are raging. It's what reminds you to buy when you're scared and to be cautious when you're tempted by greed. Without it, you're just a ship without a rudder, tossed about by the whims of the market. All of these ideas culminate in another most important thing: being a contrarian. But being a contrarian isn't as simple as just doing the opposite of whatever the crowd is doing. That's just being a rebel without a cause. True contrarianism is about thinking for yourself and reaching a conclusion that is different from the consensus. And, critically, you also have to be right. Being a contrarian and being wrong is a very fast way to lose a lot of money. This is why all the other most important things are prerequisites. You need second-level thinking to develop a variant perception. You need a deep understanding of value and a margin of safety to know when your contrarian view offers a compelling investment. And you need to understand where you are in the cycle to know when a contrarian stance is most likely to pay off. Being a true contrarian is incredibly difficult psychologically. When you're buying in a panic, everyone around you, the news, your friends, maybe even your family, will tell you that you're insane. You will feel intense pressure to conform. When you're selling or being cautious during a raging bull market, you will be racked with the fear of missing out as you watch others get rich on paper. It takes immense conviction and emotional fortitude to stand apart from the herd. So where do you look for these contrarian opportunities? This is the next most important thing. Finding bargains. Bargains don't exist in plain sight. They are not found in the popular, well-loved, and widely followed parts of the market. According to Marx, bargains are typically found in assets that are misunderstood by the majority of investors, considered too risky or tainted by controversy, unpopular or out of fashion, or simply ignored and underfollowed by the mainstream financial world. Think of it like shopping for vintage clothes. You're not going to find a bargain at a fancy boutique on Fifth Avenue. You find it by digging through the racks at a dusty old thrift store that nobody else wants to bother with. It's the same in investing. The real treasures are often found in the neglected corners of the market, where you have to do the hard work of digging through the junk to find the hidden gem that everyone else has overlooked. Once you have this entire framework in place, you arrive at what might be the most difficult part for many people: patient opportunism. This is the next most important thing. Investing is not a video game. It's not about constant action. In fact, for a great investor, much of their time is spent waiting. They do all the hard work of analysis. They understand the environment, and then they wait patiently for the perfect opportunity to present itself. Marx calls this waiting for the fat pitch. The analogy comes from baseball. The legendary hitter Ted Williams was one of the greatest of all time because he was incredibly disciplined. He mentally divided the strike zone into a grid of 77 baseballs. He knew he could only hit the balls in his happy zone, the pitches right down the middle, with real power. He would let perfectly good strikes go by if they weren't in his sweet spot. He had the patience to wait for the pitch he knew he could crush. Investors should be the same. You don't have to swing at every stock that comes your way. There are no cold strikes in investing. You can let thousands of opportunities go by. Your goal is to wait patiently with your capital ready for that one fat pitch, that incredible opportunity where a high-quality asset is selling at a ridiculously low price with a huge margin of safety. Then, and only then, do you swing, and you swing hard. This entire process is underpinned by one final, critical, most important thing: knowing what you don't know. The greatest investors are not arrogant. They are profoundly humble. They have a strong awareness of their own limitations. The famous investor Warren Buffett calls this the circle of competence. The key is not to have a giant circle, but to know exactly where the boundaries of your circle are and to stay within them. You don't need to be an expert on biotechnology and software and banking and energy. You just need to find an area or two that you can genuinely understand better than most. And for everything else, you need the humility to say, I don't know enough about this to have a strong opinion, so I'll pass. This also applies to making predictions about the future. Marx is a huge skeptic of macroeconomic forecasting. He believes the world is far too complex and random to be predicted. So instead of trying to predict whether it will rain, he focuses on building an arc. Instead of betting on a single economic outcome, superior investors prepare for a range of possible outcomes. They construct portfolios that are robust and can withstand different environments. They position themselves not based on what they think will happen, but based on what they can buy cheaply today. Finally, the ultimate most important thing is putting it all together. No single concept we've discussed works in isolation. Superior investing is like a complex combination lock. You need all the numbers, and you need them in the right order. You need to combine second-level thinking with a disciplined approach to value. You need to layer on a deep understanding of risk and cycles. You need the emotional fortitude to be a patient contrarian. It's an art, not a science. It's not about finding a magic formula that spits out winning stocks. It's about building a comprehensive mental framework for dealing with uncertainty. It's about being a historian, a psychologist, and a business analyst all at once. The lessons from Howard Marks in The Most Important Thing don't provide easy answers, but they provide a timeless philosophy for navigating the complexities of the market and giving yourself the best possible chance for long-term success.